Why don't you tell me about yourself and then I'll introduce you to me and then we'll jump in.
Yeah. Well, I've been working with a network of 200 PhDs. It's kind of like the setting is kind of like an R&D type of firm, or I
Hmm.
would say more like a venture studio where we invest in early stage startups. We create the technology. Sometimes we just embed any type of science, any model that they need. And then we also invest our own capital and then other investors, LPs capital.
Wow, fascinating. And where are you based?
I'm based in Chicago.
Nice. Okay. And we'll get to how I found you in a second here. But Sheila, I spent 17 years as an operator in Silicon Valley and I was part of an IPO, then I ran kind of early growth and growth stage companies, either as the CEO or as like a CRO, COO. Raised a bunch of money and then decided that I wanted to be on the other side of the table and actually bring kind of that operator experience to startups because I think from your research that founders are looking for someone who can be empathetic and also understand their business and the situation. And so our underlying presence, our reason to exist is that we believe that operator investors can deliver better returns. And so when I was looking for that Cambridge number, and then your profile came up on LinkedIn, and, so tell me how you guys think about the research. So how did you get into doing this type of analysis? How did all that begin?
Well, I guess it was just my curiosity to understand more about the space and understand what was going on with bigger funds like
Yeah.
E16Z, how they were structuring themselves and what was happening with LPs and also institutional money. And then we work with a lot of family offices or high net worth individuals, and that's easier because uh, you see how institutional money, even though they know all this data already, but in reality, there are other things at play right now. Like I guess brand is more
Yeah.
important for them than performance, I would say.
Brand is more important. So let me back up. So the what drove the research, it sounds like, was a question from one of the LPs. Is that right? Like, to what extent are operators better investors? So you started out talking about A16Z. So let's start there. They
Yeah.
raised a $15 billion fund recently, and I saw a statistic, I'm sure you did, that they in 2025, they represented 20% of all venture capital raised. These guys, like, I've known them since I got to Silicon Valley. Bill Campbell was my mentor. He mentored Ben Horowitz. So are they still operators? Like, if you think about your premise of this 1.7 outperformance index, does that advantage scale at a firm of that size? So does Andreessen Horowitz LPs get the advantage of them as operators?
I don't see how I don't really know how they operate right now, but I don't see how you can scale those performance. You can see it with a model of, I think it was GTM fund. They try to cap their investments for per operator 20%. And the data is very clear. Funds under 350 million, 17.4% IRR. Funds over 750 million, approximately 9.7 IRR. And then funds over 1 billion, 2% IRR.
Oh my gosh.
So, yeah, GTM fund explicitly said operator capital doesn't scale infinitely.
Yeah.
And so my understanding is in the case of A16Z, 15 billion fund or more, I mean, sizes, they need to deploy at least 3 plus billion per year. That requires either huge check sizes or massive portfolio.
A lot of checks.
And both kill the hands-on model. So my understanding is the ceiling seems to be between 200 million, 350 million. And beyond that, you can't stay hands-on, right? You could hire non-operators, but you compete in mega rounds where your operators edge much less. And my understanding is the edge lives in the hands-on work, and hands-on work doesn't scale. That's the reality.
So we have companies. We are taking a concentrated portfolio approach, Sheila. So each of our funds is somewhere between 12 and 15 companies. And so that allows us to do a lot more diligence on them prior to investing and to leverage our networks as part of the due diligence process that actually ends up helping the company. So we'll make customer intros, we'll do a lot of the things that an operator would do, right? I'm going to have you talk to my best customer. I'm going to have my best sales rep interview you to see if they could sell your product. So we do a lot of that, and I believe it does not scale unless you have more operators. And so, kind of give me a sense of if you were designing a framework or an ideal firm that could scale its operational advantage beyond 300 million AUM, like what would the structure look like?
Well, I really like if I have to take a look at what I was researching, and maybe there's information that I lack, right? But one that I like the most in that regard is a GTM fund, because they at the time I was researching, I think they had like 300 operators, and now I don't know if they scaled it to 350 operators, and in a way that they are trying to build that network, not a hero model, but more like a network that could scale and also create an ecosystem. And that took them longer, right? And you need to be selective also about the engagement, right? I would say that I will concentrate more on high touch on critical moments, like fundraising, pivots, key hires, and then low touch on execution, like let the founders run their companies. And I would say your edge comes from when you engage, not how much
Absolutely.
the time, like you were saying, no, for these particular activities, I'm gonna engage. And for these other particular activities, I prefer them to run their operations.
Run their plays. Yeah, so
Yeah.
the way that we think about it, Sheila, is kind of like in 3 chunks. So one is there's a lot of work at the early stage to be done with the founder on mindset, how to think about things not as a fire starter, but as a fiduciary. So kind of like that mindset. So it's more of a one-to-one. But the second is designing how they're gonna go to market because I've experienced that that is the point at which the company is setting its destiny. They're either gonna blow a lot of cash on bad things that don't make sense, or they're gonna build a learning model for how they scale. And then the rest of the engagement is more of like interventions. Okay, we're seeing that churn is spiking, or does that mean we have an ICP disconnect? We're seeing that engineering is churning. Is there an operational challenge with how you're thinking about product requirements and how those move through the organization? Or ACV is declining. So we look at the bright levers that happen, and then it's about how do we intervene from a playbook standpoint. So when you're evaluating for this operator model, are there are there companies or firms that have done that at scale? Not the hero model, but the other model you talked about. I think you said the hiring operators and hiring people like GTM. What do you think about how Bain Capital has done it, where they have playbooks and they have institutional rigor and knowledge and tools that companies can use? So, is there a way to mechanize some of the intervention? Is there a way to bring those tools to the founder for their benefit?
What do you mean by Bain? I need to go look it up and send it to you. But I think they said something about 12% of those transformations really excel. So, what do you mean? So you have the operator-led funds, then you have the other funds, VCs that are trying to catch up and hiring those operators. But it's not the same thing, because to hire a celebrity chef, then the celebrity chef should really run his own restaurant, right? It's not the same thing. And plus you have skin in the game.
Yeah.
You have been there, and also you have the relationships and the connections. I mean, startups come, I guess when startups need to solve a problem, they need capital to solve any, they will really come to you. And those deals are out of traditional VC. They don't even see it. They come to you to help them solve a particular problem. Like for us, what happens to us is that whatever it has to do with science, They come to us because they need a model and they know they can have a model from us. And that's easier than just build your own models and then hire a bunch of PhDs that you don't even know, you don't have the capabilities to manage those people. So in a way, you come to us to solve those problems. And those people, I mean, they are not even these traditional VC wouldn't even know this.
Yeah,
Wouldn't
I
be
think they wouldn't be in the room. I mean, I think you point out
exactly.
a really interesting difference that I see, and it's around the currency inside the network. So here's the difference. My VC meets someone at a conference, they have a 15-minute conversation, and then my VC says, "Oh, you should meet that person." Versus this person has worked for me at 4 companies. I know what they're great at, I know what they're good at. Or this is my former customer that I sold $1 million contract to. And so whenever we make intros, we try to do it from the highest currency down. And what I think happens in traditional VC is those relationships are not rich because they don't have any history or currency in them. So, right, like there's a firm that we've worked with, Sheila, called Bets Recruiting. I use them as an example. They have worked for me 1, 2, 5 companies. They probably have hired 500 reps for me from through all those companies. And so if I recommend them, I know because I've kind of seen all the evolutions of that firm, and I know that it has worked for me, and I know what hasn't worked. So I completely agree that the networks look different. I'm gonna come up with a framework. I know you're the scientist, but let me come up with a framework. It feels like operator-led can come in one of 3 forms. It can come in the hero model, where you have one person or a few people who are operators and have deep expertise. It can come in the ecosystem model, where you have like the GTM fund or the operator collective, where there is a plethora of people inside that network who all have skin in the game. I would say there might be a third, which is more of a playbook. And I'm gonna bring up YC. Even though they're not a great example, I think they understand the playbook and how to intervene in specific times and points in a startup. So, do you think that you seen those 3 models of operate: hero, ecosystem, and playbook, where the playbook is more of an abstraction, um, or consultative, if you will?
I guess it would depend on the stage and the capabilities of the people that are running those playbooks. Because if you think about it, now more and more VC has like YC. I was looking through YC and I've noticed that um, I think in the past they had a better success rate than they have lately. Like I've been trying to have conversations with those founders, and some of the people are just out of the business. They are just doing something else. They are not even maybe a 1 or 2 years. So like you could see how they are populating more and more and more. And before you would think about YC as a majority of these entrepreneurs would be successful. And now I would say they grew quantity, but no quality. Maybe at
This
the end,
comes back to your point, yeah, that it doesn't
yeah,
scale.
it doesn't. Yeah, I guess they are, and now with the agentic and AI and valuations being so difficult to understand. Like
Yeah.
for example, to me, it happens to me that I have a couple of fellow VC friends, family offices, or small VCs that come to us to, for example, because we have a lot of knowledge on AI,
Okay.
and he was like, "Well, this is either this is super overvaluated. I mean, something is going on, or I don't understand what is going. So please help me." And that's why I've been, if to be honest, I've been putting together a lot of investment memos for other fellow VCs, just because it happens that we are in the field of AI for many years, like machine learning, because it comes from science, right? So, I mean, you could have all this, and also yesterday I was analyzing a deal. I was analyzing a company at Y Combinator. It caught my attention. It was a gaming company. I think it was called Historia or something, like a strategy
It's a
game.
good name. I like
Yeah, and I was looking at it. I noticed that it's a strategy game that you compete and you play. I mean, you play against you buy tokens. You use your tokens for leveraging your conversation with AI. So you're playing against AI in a way. And you choose your settings like I don't know, like World War II or whatever settings. And I was thinking, how many of these games that Y Combinator accepted? And the data, I was looking, I was researching through their whole story, and maybe they have invested in 40 of those,
Wow.
right? That industry. And but I've seen an amount of like Y Combinator. I think Y Combinator is getting bigger and bigger and bigger and becoming more traditional. I don't know how to say this, but and then you talk to these entrepreneurs and they are out of business in a year. And that's I don't have the numbers, but my guess would say that maybe I don't know, 60, 70% or more. I would say more are out of business.
That's a high fail rate. I believe that these 3 models need to coexist in a firm. I believe that a firm we have a lot of AI companies right now in our portfolio, Sheila, and here's one common reality. If they're selling to large companies, those companies don't know how to implement AI. Like, people know how to use AI Copilot to make cool pictures or to do PowerPoint, but if you're selling a complex system to a large company, they don't have the talent. And so we're finding more and more of them needing to do ontology work, needing to do Palantir calls them forward deployed engineers. Like, they're needing to do much more of that. And so we have a playbook around how to do that, which is how do you, from an economical perspective, build a program where you can help customers in the field. That comes from experience and operating knowledge, but we built a playbook around it so that we can now match someone in our ecosystem to help you go implement that. Either have a buddy at Cloudera who's an expert and someone at Oracle who does it really well. So in my mind, it doesn't scale quickly. And I believe it requires some level of codification of what works and what doesn't. And you can give that to the founder so that he or she can execute to the point that you made earlier.
Yeah, but yeah, as you said, you can like custom made that particular playbook for that particular
Company.
but
Yeah.
pattern, yeah, and pattern that you
The
were
pattern.
seeing
Right.
that you could. So in a way, you kind of like had to custom made it in a way. It's
Yeah.
not something that you would, and maybe for other type of businesses, you would custom made another plate. Yeah, I guess as you said earlier, that maybe these models coexist in a way. I really like what GTM Fund did in a way how they stay small, but they grew with those operators.
Yeah.
As
The
they
ecosystem.
they build the networking. That took time, right? And then they also stay specialized. Because yeah, like you were saying, like maybe you guys are doing, right? Like you have the right person who to call
Yes.
for that particular problem that needs to be solved.
Yeah. And I want to go back because I wrote in big letters on my paper here, brand over performance.
Yeah.
Uh so so is that you never get fired for buying IBM? Is it that energy at the LP level? Or is it
It,
just not having the tools to do due diligence on an emerging manager or a challenger firm? Like, why does that happen?
um, it's a paradox, right? Concentration is increasing, not decreasing, in a way for those
Yeah,
big
yes,
as.
yeah.
And I put together a couple of notes here that brought
Please.
from the research, right? But in 2024, the top 30 funds got like 70% of capital. But at the same time, 42% of new funds were micro funds. So 1 million, 10 million. I think that information comes from Carta. And I can send you the sources and all that. So they grew. I mean, yeah, they are growing. But what happens is I call it something like bifurcation. Institutional LPs are doubling down on mega funds and family offices and high net worth individuals backing operator led emerging managers in a way. As you see the data from Cara from 25% in 2020 to 42%
Wow. Wow.
allocated
Wow.
in those micro funds. So and as I told you, when I had that opportunity to meet with that institutional NLP and I show the data, they say, "Well, we have seen the data, right? But they know the data,
Yes, they know it, right?
but we need." Then they start going on a branch like, "Yeah, well, but we need liquidity, or we can deploy our capital in small checks, or big brands feel safer in a way." That's about
It's
what I was.
predictable. It's predictable 8% versus potentially a volatile 17.4% IRR. It's interesting. So, I have a couple of family offices that are in our fund, and they diligence very different than the institutions. The families diligence by their gut, their instinct. It's obviously their money, so I think they feel much closer to it, but they've also been operators. And so many times a family office is either running an operating business or they come from an operating perspective, right? And so they're bringing a sense of, do you understand what your companies do? And so they ask very, very different questions. So where an LP, institutional LP may say, tell me how you source. A family might say, walk me through the revenue model for this company and why you believe that scales. It is very, very different between the 2, and I find I'm not surprised by the data because I imagine families are closer to how money gets generated, whereas allocators are rewarded on predictable revenue, right? I mean, wouldn't you say it's the reward system and incentive structure is very different for each?
Completely. They have different incentives, and that's the incentive structure is what drives them. We know that concentration is increasing, but the market is catching up slowly. Institutional capital hasn't shifted proportionally, right? But
Yes.
I guess slowly it will, it, I don't know, I couldn't predict it, but I guess
I was gonna ask you for your prediction.
I know personally, I would say that, and now also big corporations fail, like not only on the VC side, also you can see it on the private equity, how they were investing, big companies were investing a lot of money, and now they are not results are not showing. So I guess this is happening across investing, like the private, I would say the private market. There's a proliferation of these emerging founders that are showing better and better results. So I guess we are going to need some time for those institutional LPs to really feel more comfortable just after seeing year after year how performance gets maintained. Like when you build reputation in a way, all those brands build like big companies, big brands. And if you think about it, A16Z, they started small
They did.
and they create that reputation that now they have this really big brand. But I guess when you start doing your own due diligence and you are kind of like uh thinking more into asymmetries in a way,
Hmm.
and that's what you're trying to do, right? To get those asymmetries and those modes, I mean, those institutional LPs would feel more comfortable seeing after year these finding out those operator-led funds, people like you, for example, and seeing them year after year, year after year showing results, they are gonna feel more confident, I guess, in the future. That's my understanding.
Yeah, I mean, that's a natural economic model on some level, but you will also create, like you talked about the bifurcation, it means that you will have inherently large overcapitalized firms and you will have small undercapitalized firms, which means a lot of these will die and a lot of these will
Yeah.
underperform. And so you will create a systemic issue as a scientist that you will starve these. Those will become the middle class, the ones who can survive, but I think it will be very few because what I feel is underappreciated is that emerging managers, we have a cost base. We have to actually run a business. We have to pay people, and
Exactly.
we're paying against the expectations set by the mega fund. So if you want great talent, you have to pay what a large fund or firm might offer, not what a lower one will. So how do you see this kind of zombie firm? Like, what do you think the play will be for those? Will they only raise one fund? Will they merge and be bought by the larger funds? Will they combine together and kind of leverage synergies?
Concentration is the first thing that comes to mind and it's on the table. But how do you see smaller firms working together? Because you have more that type of fund created already. So how is your collaboration model with other companies?
It's a really good question. I prefer them. I believe that operator-led funds have one thing that, like, no one talks about is I believe that we can generate higher conviction in companies than investors who don't understand the signals that they're getting. So, there was a company we invested in, it it was not growing quickly, low valuation, but we saw, like, all these inherent go-to-market advantages, Sheila, like, there were at least 3, but they were underexploited because the founder didn't have direction or tools to unlock any of them. They existed in the
Yeah.
product and in how they go to market, but they weren't able to unlock them. So we got in and we were like, "Turn, turn, turn, 10x growth." And so the founder did it, like, it wasn't us, but we were the initiators of that, and so we went in with conviction because we saw the signals, and so when I think about the community I wanna build around my portfolio, I want them to have other operators who bring different experiences because there's a firm that I really love called Bonfire, and there's a guy named Brett Keener who is a partner there, and we were both operators at the same time. And so I will call him on companies where we're in the same when we're in a deal together, and I'll be like, "What do you think about this, this, and this?" And he's like, "Oh, I interpret it this way." And I go, "Well, I don't." And we talk about it, and then we will go to the founder together. And so I think the collaboration is much, much easier with other operators because we're kind of coming from a similar point. Boardrooms can be very political. And the boardrooms that I see being more political are the ones where it's about the size of the last check written versus the quality of the perspective or insight. Does that make sense? Like,
Yeah, it makes
yeah.
total sense. Yeah, we been in those. I have to sit in a couple of board. We call and we create a board because we are so early that we say, hey, we need to create a board, and we help them create a board. We sat in the board. We don't put all the shareholders on the board because we know this thing.
100%.
But yes, it's and at the point it's also an ego thing I've seen sometime, not just a check, also the ego. And yeah, and that kind of like get the CEO dizzy in a way, right? Because you are
Who do I listen to?
yeah. And then yeah, and also as an operator, because for example, for that particular fintech company, I had several hats. I was the chief product officer. I created the whole product, and and I was just sat in the board. I have several hats, and it was very. Thank God I don't have ego. I'm more collaborative, but I mean, it's yeah. You could see how it was. There was some friction at the board level, and yeah, it's but on the other hand, you need that board level because those operators are operating,
I
and
think
you need that strategy layer.
but the
That
board
is
is
that.
often not the strategy layer. They are a governance layer. They are an oversight layer. I think what you're talking about is absolutely essential, which is that because what happens is boards become a compilation of cap table, like they reflect the cat table.
Yeah,
They don't reflect quality of strategic insight because I think a really good board meeting has a fight. It has a fight in it.
yeah,
My family's from Venezuela and from West Indies, and we call it sobremesa, which is like you fight over the table. Like you have
yeah.
right? You fight over the table, you talk about it, but everyone forgives and moves on because it's for the benefit
Nothing
of the
is perfect.
company.
I always say, well, that was our idea. Our idea was always to say, hey, let's just create this layer strategy, the strategic layer that
Yeah.
operators are too close to the operation to
Yes.
really
Yes.
think it strategically. But we created with that thing in mind. But later we notice all that ego politic. We started
Cap table dynamics.
that, yeah, and the governance and all that.
Yes.
So it was, I mean, the good thing about us is because we own the product in a way and the IP sometimes, we have like a, in a way, we have all the data and everything is, it's very difficult to just have hints in our, or let's say moods or ideas. It's just raw data for us, right?
Yeah.
So, but yeah, I've noticed that, well, our intention that was more to create that strategic layer, it's not always achieved fully like we intended when we created those boards, because sometimes then the other dynamics take place, right? Like the governance, or as you said, cap table and ego and all of those. So yeah, I guess as you said, I don't know if the board is gonna solve
The
that.
strategic issue.
But
Yeah.
exactly. So then having maybe someone like you in the middle, like how do you do it, right? We found those problems, and at a point there's an amount of fiction that you can take, as I always say, right? When you wear several hats, there's an amount of, unless that you unless that you maybe you create a playbook for that, custom playbook, just for a new way of behaving at the board level. And
We do.
in
We
okay,
do.
and
And I know we'll talk about that later, but I think you've just nailed it. So the three dysfunctions of a board, one is it's not designed. It's a reflection of the cap table, right? It's so that's one dysfunction. The second is you often have really smart, most VCs are really smart, but you don't give them the right data in the right amount of time for them to process it. And I believe what you said, which is the ego and the dynamics of like, I don't wanna piss this guy off because I want him to bring me into deals in the future, so I'm just gonna go with what he says. And so I would say the dysfunctions need to be managed by the CEO. And the CEO has to say, let me not bring this issue to this entire group. I'm gonna carve off a subgroup and we're gonna discuss this. But most founders don't see their role as that, as the orchestrator. But anyway, we'll come back to that. Let me ask you 2 questions, Sheila. If you were advising an institutional LP that is getting the information that you just shared, 9.5 versus 17.5, and they want to shift, what strategic counsel would you give them about how to look at operator-led firms as part of their overall portfolio? Like, how should they approach it, and what should they look for?
I guess I will start trying to understand what are their fears. First, try to understand what
I
are
was
their
not
fears.
expecting that. Okay.
No, yeah, because you want to know if this is something personal. You want to know if this is something you just need to
Structural,
under.
yeah.
Yeah, maybe the
Yes.
person already is aligned with you. Maybe the
Yeah.
person that you're working, he's aligned with you,
Yeah.
but he can set. There's a buy as a before doing everything that I'm doing. I was a consultant, right? Strategy consultant for Fortune 500 companies, mostly in Latin America, but I mean, American companies and European companies that were operating in also in the whole region in Latin America, and companies like MetLife,
Wow. Yeah.
big banks. And I noticed I noticed it. I'm not going to say the company, but I noticed we had this steering committee and we had that CEO of the whole region, right? Number one person of all, up below the US, number one person. And he had, I call it all the ministries. I like to play around that he was the president in all the ministries. But and now I was talking in all the meetings. Now I was talking, and I was the only one talking. And then the CEO was like, "Yeah, yeah, follow what Sheila is doing. Let's do this." And then I was thinking, what is going on? I need to understand why no one talks here. And then later I realized the CEO was so strict. And there was a dynamic already in the culture of the company that they couldn't talk. They it wasn't that they weren't smart enough or they didn't wanna follow the innovation or follow that path. It was that they didn't feel the right or safe to really bring their ideas to the committee. And that's what I want to understand from all these institutional firms. First, I want to understand the person that I'm dealing with, that I'm having the conversation, try to understand. Maybe I will try to understand what is holding him back from investing. Is it a buy-in in the organization? Is it particular fears?
Maybe it must be emotional.
Well,
I agree. It probably starts with emotion.
something because numbers are there, and they could say, yeah, I mean, this is too slow, and I want to cash out before what liquidity, whatever. But you can grab an amount of money and say, let's say you can say, okay, let me just start with something, right? With and a small amount. Let's start with something. So I would try to just understand the fears first. First meeting, I would try just to try to understand the fears. Where are those coming from? How can I overcome those obstacles? How can I, is it data? Maybe it's not data. Maybe something else. Maybe it's openness. Maybe it's, I already seen the data, but maybe if we are open and we work together, maybe if I'm just an arm of your company
Mm.
that is feeding you all the data so you feel comfortable. What is it? What is it that would make them feel comfortable to just allocate small amount, just start with small, see how it works, and then maybe increase their presence with those emerging fund managers. Just just try to see how, as you were saying, you had to custom create custom playbooks. The same thing here. I think you need to think about, I would think about it like custom plays in a way like, how am I going to approach these people? What are their fears? What are their committee fears? The person that I'm dealing with fears. I mean,
Yeah.
try to understand that and see what can I offer to them to make them to make them feel that they could try with something.
Yeah.
And maybe
Ooh.
maybe not with the whole portfolio, maybe with a particular company.
Yeah. I
How
think
can I be
that's right.
that mediator? How can I be that translator?
I like that you started out with the emotional aspect because as someone who used to sell, I know that a lot of this is our emotions first, so then we use data to kind of justify. Tony Robbins was a mentor of mine, and one of the things that he always said is that people are driven by their lowest, like they're driven by a need for significance. They're driven by a need for belonging. They're driven by these needs, but at their root is fear. And so
Yeah.
I think you're right that it's easier to go with the brand. It's less fear-based to go with the brand, even if you get lower performance. I think what's gonna happen is that the scarcity at the emerging and challenger level is going to result in some outperformance, like top decile level performance, top 5%, and the allocators are gonna say, "We insist on being in those asset classes with these types of managers." So I don't know if necessarily it's gonna be driven by the allocator because, again, go back to motivations and incentives, but I believe that, like, the head of the foundations are gonna say, "No, no, no, I want that." Right? "I want that." And the way that I think we'll see that it's happening is that founders will gravitate to those firms. They will not gravitate like, when I was a founder, being one of 4,000 companies 1 in 4,000 was not appealing. If I could go to a firm that I was one of 40, oh my god, like, I had access to the partners, I could call people, they had resources, they would answer, and so I think the first step is going to be founders will migrate to those firms. Foundations and whatnot will see it, and then they'll see the outperformance, and then, my hope is that that attracts more capital because it will be a foregone conclusion at that point.
Yeah, that's a scenario. Yeah, that could be. Yeah, yeah. And on the other hand, like those firms like A16Z, I mean, they are just in a way. I was thinking about them the other day, and it's like they are just creating companies, right? They are just creating companies. They could fire the whole team, right? And then
Yeah.
I mean, and that's maybe what would scare those funders,
Oh.
right? and move them to those other emerging. Yeah, I guess collaboration. You want to feel comfortable, right? You want to work with people that you feel comfortable.
There's so much. I think about it. I mean, to some extent, when you invest at the pre-seed level, we don't. We do mostly seed. You are actually manifesting those companies into being. Does that what I mean? Like you're
Yeah.
actually solidifying the concept. And like we've got a company now that is brilliant. It's growing like crazy, but like it's not a thing yet. We're like
And
forming it. And so what I think we need from Andreessen Horowitz, which they do really well, is Mark is great at spotting innovation and seeing around the corners of it. And so we actually need companies, firms like theirs to be well resourced. I hate to say that, but we need them because they get the right to fail and they get the right to make Anthropic and OpenAI possible for the rest of us. And I feel like we need them on the frontier because they are seeing things that we don't see, and they have the capital to manifest those things at scale into being. I mean, this is getting really philosophical, but business is false. Like everything about it is a manifestation. And so I feel that we are creating
yeah,
we are creating. So I want to respect your time. Is there anything that you want to say or share before we wrap up?
I love this meeting. I love this conversation that we have. And I mean, I mean, I can send you some information regarding the sources
We would love that.
of this. I mean, whatever you need or answering to those questions because I was already answering, so I can just send it to you. And no, I mean, I guess we need more of those type of conversations and kind of like help shape the future of the industry in a way.
I believe that you are. I believe that you are. I think you need the scientists, like you said, who just give the data. Like you don't have a position. When I read your research, you didn't form an opinion before you got the data. You got the data, then you formed an opinion, which I think is hard to
Yeah.
do, but powerful.
Yes, and more and more, I guess those entrepreneurs need people like you that could guide them in a way, or people that they could trust in a way, and call them whenever they need obstacles. I mean, they are in the race against the obstacles, right? So that's so important to help them and in a way support them. And I don't know. I mean, it's tough, I guess, to be an entrepreneur. I mean, you were an entrepreneur, right? So it's so tough.
It's tough, and when people don't know that you're struggling with a problem, you feel even more isolated. And so I have founders where I'm like, what's going on? Like what's really happening? And what you uncover is they have this diabolical sales leader that does great, but also is harassing. And I've had that. And so there's a lot of judgment calls that they're making in real time. And I think what happens is there's a load, like a psychic load of all these problems that are unresolved in the mind of a founder. And so part of what I try to do, especially when I'm with them in person, is hit those. Like, I've noticed that you guys aren't making decisions quickly. Like, what's happening? Oh, I'm worried someone will quit. This person will quit if I make a decision different than what? Well, okay, that's that's terrible. We can't work that way. How do we and so part of what I'm also trying to do is the intangible is big. It's founders fighting and not knowing how to break up. Sheila, this is going on all the time. I don't know how to fire this person. We are 50-50. Oh my God, why are we 50?
Wow.
And so a lot of the texture of the conversations that you get at night is like, I don't know what to do. I don't know how to get this deal across the table. I don't like and so what I try to be is I'm not a therapist, I'm not a coach.
Yeah, we're gonna say, are you a psychologist?
No, I am not because my fundamental goal is the business. And so I will tell them, I will listen to you. But
Yeah.
my first priority is that I'm a fiduciary. And so there have been times where I've said, you need to go see like I'm not the right.
Yeah.
But I think more than ever, it's just I've having been there and done that, you can empathize and help them work through these things that seem impossible. Sheila, I could talk to you